The exact meaning of delta is the change in value from your position in the first $1 price movement. With options, it's theoretical. With stock, it's not. So in this play trade account on SPY, for example, I have 11.6692 shares of SPY, right?
Mm-hmm.
What's the delta of that?
There, 11.67.
Why is it 11.67?
Don't know.
Because if I buy 11.67 shares of stock and SPY goes up $1, how much value do I gain?
Oh, the 1%.
I gain $11.67.
Yeah.
If it goes down $1, how much money do I lose?
Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
Minus that.
I lose $11.67. That's delta. How much money do I gain or lose in $1 price movement? Right? With a stock, it is what it is. With a stock, this number is the number because it doesn't change. Like if this goes up $1, I definitely gain 11.67. If it's an option, that number is theoretical.
Okay.
Because if I buy a SPY option, right, this is my intrinsic value change, right? And this is my total value change of the option up here in the pink. This is my T+0 line. This line's theoretical. But what this is telling me is that this delta on this position is 64. So it's basically telling me if this goes up $1, I gain $64. And it's theoretical because it's an option. I'm working off a T+0 line, and we'll talk about that in a minute, right? So it's theoretical, but that's what my delta means. My next dollar price movement, that's how much I should make or lose. If it's a negative delta, like if I sold this option, now I'm negative delta, right? My delta is negative because I lose, if the price goes up $1, I lose $63 in theory.
And it's always keeping in mind because we're talking a multiplier of 100.
Yeah, but that includes that. Like this is literally $64, and I can do that because I can show you if I go to 683, 684 something, I'm down like $65, right?
Right.
That's all that is.
Okay.
Okay, that's what that means. Now, this line is theoretical because now one of the things that we all should understand about the price of an option is an option is priced based off of market demands. We have all our Greeks theory, but it's priced off of market demands. If 1,000 people come in and want to buy this option all at the same time, and there aren't people willing to sell it, the market maker's got to create a market for it, and the price of the market's going to be higher than it is now. Right? It's just like if you have a pair of shoes and you want $12 for them, but then you have 40 people come in and they all want the shoes, right? It's like, oh, I can get more money for this, right? So it increases. If 1,000 people want to come in and sell the option right away, and there's no market for it, they're going to they decrease the price, right? So the actual pricing is done on market demands, and then that's reflected back to the implied volatility. So what a lot of people think is, oh, implied volatility went up, so the price of the option went up, and it's like, no, that's backwards. And this isn't, and I'll even say that sometimes, right? And it's just a way that we talk about it. But the reality is the price went up because there was a demand spike in the options chain, and that forced the price up. And because the price was forced up, now we got an increase in implied volatility.
But isn't it so that more demand is generated because there's uncertainty in the market and traders get nervous, so they do want more insurance?
It doesn't happen until there's demand. I can be as afraid as I want. If I don't buy the option and put a demand on it, that's not going to change anything. Like if you have 1,000 people that are afraid looking at their screens and they don't do anything, what happens to options? Nothing.
Oh, nothing. Yeah. So it's just a theoretical
When they
sentiment,
take
but no
action,
action.
when they're taking action because they're afraid, then that's going to force the price up. And that's going to affect the implied volatility. And you can make this argument that implied volatility represents fear because people are taking action and it forced the price up. So they must be fearful, right? So they're making implications. Or it might be an opportunity, right? So you get a stock and they think this stock is going to, go up 1,000% tomorrow. People are actually, they're buying options, right? At some sort of crazy pace, and they're going to drive the price up of the option, and that's going to drive up the implied volatility because the price went up. Is that fear? Maybe it's fear of missing out, right? I don't know, right? But it's not necessarily fear, is what I'm saying.
Yeah.
Right. It's just a reason. I mean, I would say in the most common circumstances, there's fearfulness, and creates demand, and then that increases the price, which in turn increases the implied volatility of the options. The other opposite thing is once that fear goes away, people want to sell options, and when they want to sell options, that's going to drive the price of the options down. Right. So when there's a lot of net selling going on, like there's always the other thing to understand about an options contract is there's always like an open contract. An open contract, you don't know if it's a long or a short contract. So in other words, for every contract that's long, there's also a contract short. Like if I buy an option, somebody had to write that. It was another person, or it was a market maker, or whatever. Right. So there's always two sides to that. But if the market maker doesn't want to be short the option, and a lot of traders do want to be short the option, that's going to raise the prices, right? He's going to want more to write that option.
Yeah.
Like if you were the market maker and I'm the trader, and I'm like, I want 1,000 of these options like now. You're like, oh, okay. There's nobody trying to sell them right now. I have to write those for you. How much money am I going to charge for that? Well, there's a risk in me writing those options. Now they're going to cover that option. They cover that option by buying futures, or by buying stock shares, or by selling stock shares, right? So, but there's a risk in the time between the time they write the option and how they have to cover it, right? Because if I write you 1,000 delta in, let's just say it's some thinly traded asset, just because I want to go to the extreme. If I have to write you 1,000 delta in some thinly traded asset, if I give you positive 1,000 delta, I have to sell 1,000 shares of that asset so that I'm flat, right? If I sell 1,000 shares of that asset, especially if it's thinly traded, right? What's that going to do to the price of the asset?
Makes it rise.
It was going to. I'm selling it, so it's going to push it down.
Right. You're selling
right.
it, yeah.
Right. So, and if it pushes down the price of that asset too much, I'm going to lose money. Right. Because I'm trying to sell it.
Yeah.
So if I'm trying to sell it, I'm trying to get as much money as I can for it.
Yeah.
Right. So if I change the price of that too much, I'm going to lose money. So there's a risk in there for the market maker. Now they're doing the same thing, only they're doing it like in SPY. They might be selling the shares of SPY. It's more liquid, but they're dealing with contracts that are big enough to affect the actual price of the index. Or if they're doing it in futures, sometimes they hedge in futures. If they're hedging in futures, they're doing it at prices that will affect the actual price of the index. So there's a risk in them taking on the other side of that position, and they have to estimate that is. And if they have to make this big delta position they order, they have to take that risk into account. And the bigger that risk is, the more money they're going to want for it.
Yes.
Right. So that's basically how that works. Right. So they have that whole dynamic going on under the hood. And that is what this pink line's doing. It's like I have my I have my Greeks on this line, and this is the same on a broken wing butterfly. It's the same on the vertical. It's just that it's taking in multiple options, but it's easier to understand it with a single option. If you understand with a single option, you'll understand it with multiples.